All right, let's do this. We got 40 minutes to the FOMC, and this is probably going to be a very important FOMC statement. Usually, the quarterly FOMCs that happen March, June, September, and December have more impact of the markets, and there is definitely sorry about that. There's definitely a turning point in the markets usually from whatever rally or whatever sell off that we had before. It usually triggers some kind of a definitive and identifiable turning point in the price action of the markets. So earlier this week we talked about this head and shoulders that was actually forming on Russell 2000. We actually broke the neckline this morning, and a couple of us were shorting this, realizing that the Russell 2000 was probably going to show the weakness the first out of the other four indices, S&P 500, NASDAQ, and Dow Jones futures. So it looks like we actually did break this and probably hit the measured move target already. You can calculate that by taking, you can take the height from the head to the neckline like this, and I think it's somewhere around 50%. You attach that breakout to the actual breakout point of the neckline, somewhere around 50%, and that just happened to be on this. I talk about these type 2 Camarilla pivot trades. These are the monthly Camarilla pivots, and we just missed this area that I really wanted to short up here, this 1545 area, where we've got not only the month R4, but in the background you can see this week R3 right there. And that would have been a great short of the overlap, and the type 2 trade is always short the R4 of any time frame and back test the R3. And that just happens to be right where the weekly pivot is as well. And I closed half of this short right on this area right here at 1470 in anticipation of this trade, and we had a nice little $10 bounce. Doesn't look like it's over yet. We could back test the neckline and then go down a little bit further. There are many gaps below to actually fill. I keep bringing us back to these seasonality charts, and we are in an election year, and I have the seasonality filter turned on for election years, and I'm looking back for 40 years, so the previous 9 elections, because this year is not included. And in general, in an election year, there is some kind of a sell-off into somewhere around late May, and this varies from year to year, and then a monstrous rally into the June FOMC, which is today. The next FOMC is now being plotted on the screen, and that triggers the next big rally from late July all the way to September or October, somewhere around here. This one right here is the time where you really want to get long stocks. Depending on how we do from now until then, this is a great time to be long through the summer, and on gold as well, a short dollar trade. I've been talking about this. This is a moving target, so it says that we do go up for a couple of days after this, maybe until Friday. But remember, this FOMC date is different every year. So some years it could be today on the 10th of June. Some days it's a little bit sooner. Some days it's a little bit later on the 15th of June. Maybe some days it's around the 22nd. But on average, I am betting that this general peak in the profile where this yellow line is going, it's filling in the profile as we move along the days, and then leaves the little dotted profile has a smaller silhouette in the background. So I'm betting that between now and Friday, there's some kind of relative top in the markets. The percent stocks that are above the 50-day moving average, which is what this blue guy is in the background, is reaching an unprecedented level here, and this level is gigantic. We haven't seen a move like this in something like at least 13 years. Well, let's see, back until 2009, so 11 years. S&P 500 in the background. We have completely done a massive parabolic move ever since that May 14th bottom, where seasonality says that you should buy down here in anticipation of the FOMC. That's exactly what happened. Somewhere around that May bottom after the sell in May is done was just one of the best times of the year to go long in an election year and have a massive rally that just goes almost straight up. This is exactly what we have, and this is a great trade. I sold way too early in this. I did get 2,000 points of Dow Jones, but could have got another 2,000 points all the way up to 27,000. So that's kind of what I'm anticipating with the seasonality complex. Bonds is one of the best trades this week. If you look at T-bond futures for 30-year bonds, and you look at the 10-year profile, not for election years, not really looking at it. If you look at this little move up here, you can see that there's some kind of spike right around May 29th at the turnover to June. And we had this spike, and that's exactly what happened in the actual 2020 performance. Spike up, descend down into the FOMC date, which is today, and then have a huge rally all the way with stocks, and here's that next FOMC date, all the way into late August or September, and then stocks continue to go up a little bit usually, but bonds start to sell off well before stocks, maybe a week in advance. So on average, the bottom is right around this FOMC date, and we're actually bottoming a couple of days ahead of that. So if we look at bonds, and I bring this chart over here, this is 30-year bonds, and we have had a crazy rally from this super oversold bottom that had tons of volume down here. If I pull this up, you can see the volume just absolutely just catapulted this thing down. This is a great time to buy in a counter move, noticing that the volume was huge and in line with seasonality. We are still rising, and this yellow dots right here is the 200 SMA on an H1 on an hour chart. Looks like we can just get all the way up to this daily ATR stop and just keep going. So this bond trade is a great trade to be in. I know that there's a couple of people, at least one or two people that followed me on this trade, and if you followed from that bottom, you would be up about $3,000 to $4,000 per contract right now, and it just looks like it's just going to keep going. So this is a great hold. We're in the September contract now, so you can just flat out hold this trade all the way until mid to late August, and it's just going to be a great trade. In my opinion, it's going to be a great trade. We're repeating 2009 and 2010 for commodities and for bonds, in my opinion. Let's see. Let's keep going. Gold had a little pullback into the FOMC this morning. Not to worry. Bottomed right on this S4 monthly pivot earlier in the month. This is this is spot gold. And we've had a crazy ride up with bonds. Gold is responding to bonds. It is not responding to the dollar. The dollar is still going down, and it's on a major support now. So we use these ATR stops because they really work. And we are on the, we broke the 2019 close. So we're actually negative on the dollar for the year. And we're on this big weekly ATR stop now. So I don't know if we're just going to keep gliding down, but it doesn't look good for the dollar. I'm betting on a bounce here. It might happen with this weekly ATR stop. This is a huge support level, but no promises. Gold has been responding more to bonds and not the dollar. If gold was responding to the dollar, it would have been going straight up as the dollar was going down. The euro, which comprises maybe 50% of the dollar weighted index, has been going straight up instead. So it's been doing extremely well. Followed this trend line a couple of times and then rocketed above this previous high that was back in March. It's been doing extremely well. If we look at the yen, it has had a complete dump with bonds also. So yen and bonds are back to safe haven status almost, and they have completely dumped down. Yen and bonds are running together. This looks like it could be one of those S waves that I talk about many times, where we start up here, continue, do an initial huge impulse down, have some kind of a flat, sideways area on the way down, like this, and then at the very end, just completely, just end the way that it started down in this initial huge move down that it had, just kind of end the same way, which is a deep sell-off, maybe down to this May 6th low. So the yen and the bonds actually moved together. You can see that if I took 6J, which is the CME yen futures, it's just the inverse of USD JPY. Has a big bottom somewhere around this time before the FOMC, and it has it in advance a couple of days. So we're seeing that a little bit late this year, but that's okay, and continue past the FOMC to some kind of a relative top up here. So somewhere around June 24th is on average where this final bottom is. So that could be extended way out here somewhere, not sure. So it looks like we are actually following these seasonality moves for at least a couple of instruments. S&P 500 momentarily got to the 2019 close at 32.31. The high was 32.31.25. Big fund managers are looking at that, and they're just going to sell whatever they have as soon as it goes positive. In many cases, that's what happened with NASDAQ when it was punching up against the 2019 close a couple of weeks ago and couldn't pass it. It eventually broke, but for a while it could not pass. The next big target, if this does not hold, would be this same February 21 gap that NASDAQ also struggled with on the way back up. This is a big gap area, and they may bring it all the way to the beginning of this gap before letting it die. S&P 500 futures are lagging a little bit to spot SPX, and this gap is right where we kind of died almost. The beginning of this gap. Professionals love to bring it to a gap like this and pause it before filling. Before actually bringing it all the way back up. My prediction is that same type 2 trade that I talk about, where we top out on month Camarilla F's R4, maybe back test the R3, and then go back up again. In the best case scenario, we would actually back test this 200-day moving average back at a little bit above 3,000 before moving up. Seasonality for Dow Jones index in election years says that that's kind of what we have. Somewhere around the June FOMC, the quarterly FOMCs have this blue text and a little asterisk. This quarterly FOMC for June has some kind of a 10-day pullback from the somewhere around the FOMC, and a pullback into the end of June before the next rally actually begins. And I will definitely take a part of this rally to catch the next wave up into this election year, into the actual election. And then a sell-off that I talked about in the previous live stream, somewhere around September before the election. People kind of, professionals kind of just go, they take cover in expectation for the election, and maybe buy bonds, maybe buy puts, actually take profit on stocks, and then rebuy into the election November 4th, and hold till the rest of the year, and then normal Santa rally and all that kind of stuff take over. So that's kind of my expectation. We are extremely overbought by a lot of signals, and this kind of pause at this month R4 leads me to believe that this parabolic move that we've had for the last couple of days is totally abnormal for a recovery like this. If we take percent stocks above the 200-day moving average, instead of repeating something like 2019, and I talked about this in the previous live stream, instead of doing a curve like this where it gradually peels off, gradually tapers off. This is S&P 500 spot. If we kind of do a curve like this and maybe a bigger one, this was doing just fine for a while before it went just completely parabolic in the last 10 trading sessions or so. So to me, this signals that we probably need a break, and there's a lot of overbought indicators, and we're starting to see some general weakness in transportation stocks. If you look at, we've got some dark pool prints on rig this morning. Pull up a day chart. And we look at the rig block this morning. There was a pre-market block that happened somewhere around 9:20. I can't remember when it was. The little dot means it's a dark pool block. Somebody sold a 5.7 million shares, and at one point we were down maybe 20% below that. So if you immediately sold the open with this gap down, you would have done extremely well shorting into this. This is indicative of a short squeeze. This channel right here is the 55-day Donchian close channel. The top represents the 55-day highest close, and the bottom is the 55-day lowest close. And as soon as we broke that, it was just a buying frenzy to cover shorts. This is not bullish volume. This is short covering all the way up until a volume capitulation, and then the volume gradually dies off on the other side, and they sell the other side. So it's possible that we can come down here to this June 4th gap that's all the way down at $1.66. So that's, a significant amount lower. This is not bullish price action to me. We had some more action on Norwegian cruise lines. As soon as this March 6th gap was filled, and the block summary for the last 3 sessions, looks like we had a block at the bottom today, almost 500,000 shares, and it's a 5% above that. So somebody covered their short at the bottom, possibly, and now they're 5% in the money. So good trade. It looks like they probably did it right at the fill of that same June 4th gap right here. So we barely hit that gap. If I look at it on a 1-hour chart, this says that the price was 20.45. So what's this gap right here? A little bit above that. Right around there somewhere. Somebody either added to their short, or it looks like they actually took profit on the they took profit on their short. So seeing these block trades in advance, you could have looked at what the price action was doing and seeing that this gap up like this amid all of this selling and gapping into this 55-day Donchian channel that I like to use. I discuss in a lot of the other videos that this was probably just a short squeeze, and it was a good idea to exit out of a long that you took. I mean, a great long. If you got in at $8, $8 to $10, or even $8 to $12, you could have doubled your money, tripled your money on the way up. So that's kind of my expectation for walking into this trade today. Dow Jones has been a major shift in the allocation, except in the last couple of days, back into tech again. So people keep rotating in and out of tech, and for a moment, starting on that May 14th bottom, there was a huge amount of rotation into bonds, into transports, and into financials, and into banks, and then an exit out of bonds recently in the last 5 days. And then that helped push banks even higher with that huge bond sell-off that I showed in that previous chart for 30-year bonds, especially on the long end of the curve for 30-year bonds. There was a decent sell-off. So I've got some of the blocks, the previous dark pool levels, showing here from the past, anywhere from February this year and some all the way back to July 2019, and we kind of hit a net of these gaps, or these blocked dark pool levels, and it's really kind of just aided I think the stopping of the price. This price action is unsustainable to me. I talked about that in the live stream on Friday, and I still believe it's unsustainable. Here's Friday back on June 5th, and we haven't really done much since. So to me, this is unsustainable price action, and this volume peak that we had here, if we drop below this volume this day on June 5th on Friday, I suspect coming all the way back down to this month Camarilla R3 pivot and fill this June 4th gap that we see on some of the other tickers. I do not think that this is sustainable price action, so I am prepared with shorts that I've taken all in the area up here and in profit now. I've closed about 40% of those shorts to give me a cushion, and I will hold it into this seasonality move. The upside potential at this point is not that much to me. I think it's picking pennies in front of a steamroller, and I think that we need to actually come down a little bit before moving higher. And this is more of a calendar trade until I see what I need to see for a sell-off, if it actually happens. If I get stopped out, so be it. I take seasonality trades all year long. Most of them work out, some of them don't. So that's kind of the play that I'm looking at right now. So it looks like the sell-off might occur in the next couple of days, and we are prepared for that, or at least I am prepared for that, and I will also be prepared to buy again to do a more long-term hold into this September rally for election years. All right, we've got about 15 minutes to the FOMC. I'm going to take a break. If you're not familiar with trading FOMC dates, especially on things like currencies and futures, I would just walk away and just observe the price action, because right about 1 to 5 minutes before, the liquidity is going to completely dry up. The bid-ask spread will get huge, and we could have 1, 2, 3 head fakes before the true direction is discovered. And it could be that the true direction is not discovered until tomorrow, the last FOMC date. That's exactly what happened. There was a rally, and then the next day was total selling. And the most important day after an FOMC date is actually the selling, or the next day is the most important date for FOMC. So if we look at, if I pull up, the last thing I'll pull up here is SPY one more time. And forgive me for the amount of blocks that are on here, but one of the shorts that we took, a couple people in the group took this huge 321.94 level from December 20th was one of the major dark pool levels. There was 40 million blocks of dark pool blocks in a single day that were late blocks from the previous day, previous trading session that showed up on the tape on December 20th. And we shorted up against this level, and I'm still holding that short. I've taken 40% off or so, and I will hold that in S&P 500 futures. I will hold this trade until the seasonality play is over. We could back test this month R3 again that I'm looking at, or go further to the 200 day, but there's another big dark pool level here that's an interesting dark pool level to look at. Best case scenario for a short is coming all the way back down to the huge levels at 293.5 or so, and this other huge dark pool level from February 28th that was in excess of 53 million. So we don't know, and we're right up against this February 21 gap, and they're pausing it right before the February 21 gap. This is totally normal. This is what the pros like to do. They like to pause it right before filling. The rest of the way, it would have to go all the way up to 333. So S&P 500 about 333.30. That's entirely possible that's what they're doing. They're pausing it before the gap, some kind of a retracement, maybe fill this June 4th gap before increasing. I'm not sure. We are currently beneath a decent amount. If we look at the dark pool summary for SPY for the last 3 days, we're currently beneath a decent amount of dark pool blocks. Let me look at the previous 5 days, 5 sessions. So we're above a lot here. These dark pool levels are from previous day blocks that show up the next day, the big ones. This is the cumulative total of all of them, so you get a lot of those 501k dark pool blocks that in aggregates total 10 million or so. But in the last couple of days, this is from yesterday, so this is the June 9th late blocks that showed up on the tape on June 10th, which is today. We're about 0.16 below that, 0.16%. And these are the blocks here that showed up on June 9th, but actually correspond to the June 8th close. We're beneath those, and we're kind of floating around the June 8th level, which is actually the Friday blocks. This is Monday, but this corresponds to the late blocks showing up from Monday. So we do have some overhead resistance, but not that much. I can go back further in time, and we're above a massive amounts of dark pool blocks. Again, I think that this is unsustainable price action. It looks like we did kind of a mini, little S wave here where we started out strong and ended up just as strong at the finish in the last couple of days. I think it's also a capitulation, because if you look at the middle section, this is a way that you can also determine it, and you do something like a regression trend in the middle section. This was a nice, it contained all of the price, but not at the beginning, and definitely not at the end, gapped above the entire channel at the end. So there's a big impulse at the first, middle section, and then a final rally up to this 40 million level. So let's see what happens. Good luck. If you're not familiar with trading these FOMC dates, it could be nothing. Could be a whole nothing burger. We could just see no price action and nothing happens, and it just pauses and does nothing. Or we could see a huge sell-off. Not sure. The most important day, again, is the next day after an FOMC date. Whatever the price does the next day is usually going to trigger what happens towards the end of the week. All right, good luck.